We want to talk markets now with Chris Bitterly, head of North American investments at Citi Global Wealth. We got the Dow looking like it will move higher this morning, in large part on the back of this activist news around Salesforce, Chris. And after us all just getting back from Davos, I think there's a real question as to what happens next. There was a sort of I don't want to say a sense of optimism. I don't know what it was grounded in, but maybe it's being reflected actually in what we think the Fed may or may not do. Where do you stand?
Look, I would love to be an optimist, and I am an optimist in many ways, but unfortunately, the market action that we've seen year to date, if anything, I think that this recent rally is only going to compel the Fed to step up their hawkish rhetoric. And this whole discussion that we have around now it's a 25 basis point hike in February. This is on the back of 450 basis points of hikes last year, in addition to $450 billion coming out, liquidity taken out of the bond market. A lot of this cumulative medicine that the Fed is injecting into markets and the economy has not been seen in earnings yet. And this is why we're still playing defense and we're cautious here.
So you think there's a head fake? Look, if you've been waiting, is it you're going to sell some stuff in this market right now because you think it's going lower?
So the way that we've been positioned coming into this year is actually we've been overweight fixed income relative to equities. And even within our fixed income portfolios, we've been overweight on the quality side. So that includes investment grade, that includes government, that includes municipals for taxable investors, as well as preferreds, which were offering attractive yields. For us really to then take on significant positions on the equity side, this is going to require either a big change in the employment backdrop or a big change in inflation, neither one which we anticipate would happen over the next couple of months. So we have equities in our portfolios, but still we're talking about dividend growers. We're talking about the resilient sectors that have been able to outperform in recessions like healthcare and global pharma.
Clearly, you're playing the role of contrarian of sorts this morning. Mohamed Al-Arian said he wanted the Fed to go to 50 basis points, but he wanted them to go to 50 basis points, doesn't think that they will. It sounds like you may think that they will.
No, so we actually think the base case is 25 basis points. The Fed tends to do what's in line with markets. In terms of, I think the big question, and Mohamed alluded to this as well and pointed this out, the Fed's target of 2%, we're still really far away from that. So this idea that we're going to see a material progress down to that 2% this year, it's going to be really challenging. That's probably, we won't see that until next year. So what has to give before the Fed actually changes their trajectory? What has to give is the employment backdrop. We're starting to see signs of that, the layoffs that we're seeing within technology. But the real significant part is going to come out in areas like residential construction, which we could see upwards of anywhere from 300,000 to 500,000 job losses. Once the Fed sees that, that's when they would change course.